Hello and welcome to the FCN 401k Enrollment Overview webinar presentation hosted by Sullivan Wealth Management. On the call today we have speakers from Sullivan Wealth Management, Paul Sullivan, Investment Advisor Representative, Raj Goenka, Investment Advisor Representative, and Kobe Clark, Wealth Management Coordinator. On the call, Paul, Raj, and Kobe will discuss the FCN 401k plan history, what your 401k includes, the benefits of participating, tax breaks, getting started, eligibility, making changes, your investment choices, enrolling, retirement, withdrawals, and what to do with old or previous 401ks and IRAs. Also on the call to give a current investment market overview will be Troy Patton, Portfolio and Money Manager with the Archer Investment Corporation. We'll start off with the phone lines muted, and if you have questions during the slide presentation, just enter them in the chat and we'll try and answer them as we go along. And to get us started, here's the team at Sullivan Wealth Management. Go ahead, take it away, Paul and Kobe.
All right. Hi, everyone. This is Kobe. So the first slide I'm going to go over is just an overview of your 401k plan. So what is a 401k plan? 401k plan is essentially a savings/investment account for your retirement. And during this year, in 2022, the maximum contribution is $20,500 and an additional $6,500 if you are age 50 and above. For your guys' 401k plan, everyone is eligible to contribute if you have worked at FCN for at least 3 months and if you are age 21 and above. So the next slide, I'm going to talk about the tax savings that you guys do have access to when participating in the plan. So every dollar that you put into the plan is not taxed at the federal or state level. For example, when you have a W-2 of $50,000 per year, and during that year you put in $10,000 into the 401k, you are now only taxed on $40,000. Your contributions, your employer match, and any investment gains, interest, dividends, all these, they are not taxed until distributed during retirement. If you guys do decide to withdraw from your 401k before age 59 and a half, you will have to pay a 10% penalty as well as ordinary income tax. So the following slide, this shows you guys' employer match that you guys do have access to when contributing. So if you decide to contribute 1 to 3% of your gross salary per paycheck, FCN will then match 100% of that. Any employee contributions between 4 and 7%, FCN will then match 50% of those contributions. For example, if you were to put 7% into the 401k plan, your employer will match 5% of that contribution. If you were able to put 5% of your gross salary, FCN will match 4%. And then lastly, if you were to put in 3%, FCN will match that 3% as well. How do you get enrolled into your 401k plan? So once you meet the 3 months criteria, you can contact your HR coordinator, Perlin, for signing up. She will then put you in contact with us, and we can help you guys go over contribution amounts and talk to you about investment options. In addition to having us as your home base for 401ks, you guys do have access to your accounts through Employee Fiduciary. If you guys would like access, feel free to contact myself or Perlin, and we can set you guys up with that. So this slide, I'm going to talk about what we do at Sullivan Wealth Management. So the first thing we do is, like I said earlier, is we are your home base for your 401k. When you guys are eligible, we are able to help you enroll into the plan, discuss your risk level, and make specific recommendations for your investments. In addition to that, we do have one-on-one investment reviews that we do send to you guys annually. You guys should have received that in the mail. In addition to that, we do also have online access to your account. As I stated earlier, if any of you guys would like to have online access, please reach out to me and we can set you up on that. In addition to that, you guys do have unlimited telephone support. If you guys have any questions, if you guys would like to change your elections, change your investment options, just reach out to me and we can help you guys moving forward with that. The last thing that I want to speak about is, in addition to your 401k, we here at Sullivan Wealth Management, we do offer other sorts of investing. If you guys are interested in financial planning, starting in individual investment accounts, we are able to go ahead and set you up with those. For the next slide, I have included my email, kclark@esullivan.net. If you guys have any questions regarding your 401k or just any financial planning questions, feel free to reach out to me via email or my direct dial right here. Do you guys have any questions regarding your 401k plan?
Kobe, the lines are open. I don't hear any questions or see any in the chat right now.
Okay, if you guys think of any questions or have any questions or concerns, feel free to reach out to me. I'm here to help you guys as well.
The financial planning that we talk to clients about is, the first thing is setting goals. So we help you set goals so you'll get to wherever you're trying to get to. And the second item is we provide education on investment selection. It's not a sales pitch. It's to give you education on your choices and different aspects of different investments. So that's why the team members of a company call us, because they can't ask their employer. The employer has given the fiduciary responsibility to help you through us. So it is something that's provided through your employer, and you should take advantage of it if it helps you.
Thanks, Paul. Next up, Troy, Portfolio and Money Manager with Archer Investment Corporation, talking about investing in a market downturn, 8 principles and 9 opportunities to consider.
All right. Thanks, everybody. I appreciate it, Paul, Kobe, Raj, Jeff, for having me on. I would actually always enjoy doing this call, just talking about kind of where the markets are at. And let's just go ahead and get that elephant out of the room right off the bat here. When we talk about investing in a market downturn, and we definitely have one right now. In fact, if you think about it, the S&P 500 for the year, which is a collection of 500 stocks, pretty much the main companies here in America, they're down about 23%. That's not easy to swallow. I mean, you know, when we're looking at our investment goals and trying to keep on pace for retirement and saying, hey, we need to be saving this much, it's never a good feeling when the market's turning down. And obviously right now there's a lot of things that are making that market turn down, whether it be market risk, inflation, uncertainty about midterm elections. There's a lot of different variables to consider right now in the market. There's really 8 principles for making the most of a market downturn. And again, when I say making the most of it, I mean market downturns happen, and we're going to talk a little bit about that. But at the end of the day, I'm just going to go through these eight basic principles. Number 1, it pays to own stocks. Number 2, pullbacks and even corrections. Corrections are 20% downturns. They are to be expected. They do happen, and they happen often. In fact, corrections happen every 7 years, typically, on average. Now, they've happened a bit more here because with COVID. But prior to that, it was about 0809 when we had the previous one. Number 3, keep a long-term view to protect your long-term goals. When we talk investing, oftentimes when I'm talking to advisors all the time, I say, what's long-term? and somebody might say 5 years or 10 years, and that may be appropriate for that person. When I look at long-term investing means 50 years. It could mean 60. It could be 100 years. In fact, often, as most of us are invested, are not going to, at the day that we reach retirement at age 65, we're not going to pull our money out and spend it all in that day. In fact, we're going to spend it over retirement, and probably in all likelihood, we're probably apt to leave a certain amount of money to our heirs. So when you're investing, you're really investing not only for your lifetime, but also for your heirs' lifetime. So remember that when you look at a long-term view. Number 4, higher rates do not mean the end to equity gains. Higher rates are terrible. I mean, they stink, and everybody says, oh gosh, interest rates are so high. Frankly, they're not that high. I mean, they are comparative to recent times. However, I can think back even in the 90s when my own mortgage was at 8.5 and 8 3/4, and for heaven's sake, I sound like my parents at this point, even though I'm in my 50s, because I remember at the same time when I was young and I used a market downturn like 1994, I would talk to them. They said, "Yeah, Troy, you know what? Rates were 12% when I had my mortgage." So rates are still low from a long-term perspective, and frankly, they may end up going lower again. However, higher rates don't mean the market falls apart, because if that were the case, we've had higher rates before. We've had much higher than this, and the markets still move higher. Number 5, volatility often comes with raising rates and midterm elections. Volatility is the up and down of the market. It jumps around a lot, right? And the more uncertainty that is created, the more volatility we see. The market jumps up and down, up 3%, down 3%. And if you're the type of person that likes to look at your account daily, it can about make you crazy, all right? Number 6, non-recession bear markets are typically more shallow and rare. And you say, and I always hear this all the time, Troy, we are in a recession. No, we're not in a recession. A recession is defined by many factors more than just the reduction of GDP. For instance, if you look at our employment here in the country, I believe we're, as of last Thursday, I may be mistaken on that date, we're at 3.5% unemployment. In fact, we're adding about 260-some thousand jobs, per month. So, the jobs are still plentiful. There's not as many jobs. There's actually what's called a job opening index, and that's actually all the jobs that are listed out in the papers. It is down a little bit, but there's still a lot of jobs out there. In fact, there's more so than in any time during any recession. Okay, so and market timers miss out. If you try to time the market, it's tough to do. You have to be right twice, right? It's like playing blackjack. If you sit at the blackjack table long enough, you're going to miss out on hands, and you're going to end up or you're going to hit every hand. You're going to lose money. It's just the same way in the market. You have to be in the market to make the money. And then number 8, make lemonade when you have lemons. Engage in creative tactics to increase your wealth. And I'll talk a little bit about that. If we can go to the next slide there, Jeff. Thank you. So when it comes to funding investment objectives, if you take a look at this chart, history has shown that there's really no alternative to equities in providing better potential for capital growth over the long term. The market has overcome temporary setbacks of all kinds and has continued to march ahead. Just as the slide says, the spoiler alert, excuse me, I can't hardly speak, stocks have gained over the long term. If you look at this chart, it's a great visual, and if you kind of zoom in and out and understand that U.S. equities have survived every setback, no matter how dire the situation may look in the moment. This chart here goes back to 2009, but heck, we can go back into World War I, World War II, the Vietnam War, the Iran-Contra hearings, 9/11, that's not even on here, the dot-com bubble, COVID, the Spanish flu. I mean, we can go on and on and on about these different these different points, but inevitably the stock market always moves higher. Next slide, please, Jeff. But basically, this chart, all it does, folks, it tells you that stocks actually go up more than they go down. However, there's 11 times since 1926 the stock market has finished down 10%. Okay. However, 60% of the time it actually is higher than 10%. So 57 of the 96 years, and 75% of the time the market's just flat out higher. All right. 36 of the 96 years that we're looking at here, 37.5%, the market's up 20% or greater. So, if you look at the chart, it's just skewed. Let's go to the next one. Hopefully that one will show up a little bit better. Okay, here we go. These are all the years, and you can see there's quite a few years where the market's been higher, right? Well, actually, I'm sorry, this doesn't show that. But what it does show is it shows that there's 3 to 5 drawdowns of at least 5% over the course of any year is normal. I mean, we can go back here and in 08, 09. I mean, look, there was 24 and 11. And 2022, I think that number now may be more like 5. I believe we're at 5. But 5% drawdowns, it's pretty normal. So this is nothing new, and the market tends to come back every single time. If you'll go to the next slide for me. Looking at this next slide, and this just kind of bolsters that point of the previous slide. So even the best returning years to the markets have at least one intra-year decline, with the average intra-year decline of about 14%. Year to date, as I mentioned, we're down about 23% as I'm looking at the market actually right now. Even though today it looks like the market's up about 0.25%. We're down 23%. I can look across the board and it says, wow, there's a 34, a 30, a 34, a 38, 49, 34, 20, 28, 23, 20. All those years where we saw intra-year declines, but yet at the same time, it just popped, the market popped right back up, okay? And remember, annual returns were positive for 32 of the last 42 years, okay? Next slide, please. All right. As I talked about time horizon a little bit earlier, and obviously I want to make the point here just a little bit further, the longer your time horizon, the less frequent the occurrence of a negative return from stocks. So if you've been invested in the stock market, the S&P 500, over the last 10 years, I believe the negative rolling periods, and this is from, this chart is 1970 to 2022. I want to say there's only 2 times that the market was below 10% in that 10-year rolling period. But then right afterwards, the market had been much higher for the next 10. So the average 10-year rolling period posted positive returns 92% of the time. And obviously, if you have a greater than 10-year time horizon, you can see there that in 15 and 20 years, the market has never been negative. And that's why I say, if you were retiring at the age of 65 and you look over the next 15 years, as obviously average lifespans are much higher than 80 anymore, you're probably going to be positive. Now it does matter when you start pulling out. Obviously, if the market's in a downturn and you pull out in that year, that can impact your savings amount. But if there is anybody planning on retiring, oftentimes when the market is low like this, you really want to try to either delay that retirement or take a lesser amount or try to use other monies that are not in the market until the market recovers. Okay. This next slide is the investment time horizon. Just kind of reinforces that point again. The longer the time horizon, the stronger your opportunity for higher returns. Here, for example, we're talking about a 5-year rolling period. If we look at that and we say a 50-50 stock bond portfolio, it could return anywhere from 1% a year, right, to 21% per year. You see that? Over a 5-year period of time on a 50-50, 50% stocks and 50% bonds. Now, obviously, stocks and bonds can be much more volatile during a short period of time, such as 1 year. And in fact, here, if you look at the 1 year of 50-50, we can be down negative 15 or up 33. And in fact, if you look now, and this is through 2021, this number is actually greater. If we were to end today, that 1 year number would actually be greater than that negative 15 because bonds have actually underperformed as well. All right? Okay. I love this slide. This is a slide that J.P. Morgan put out, and I think it's a really good slide. And we talk about where the market's at currently, and I think on this date we were talking about, I thought it was September 15th. The market was down. I think we might be even down a little bit more. And so you kind of pose the question to everybody, and you say, do you think the market's going to recover? Do you think it'll get back at least to where it was? And if your answer is yes, you say, well, how long is that going to take? And you look over here on the left and you say 1 year, 1 year, 2 years, 3, 4, 5. And if it takes 3 years for the market to recover, okay, back to its high, it'll be a 29.1% return and an 8.9% implied average annualized total return. So your cumulative return will be about 29.1%. That's pretty decent. I mean, I think if somebody could say, hey, Troy, I'm going to give you 8.9% return today, I'd be pretty interested. And I think, looking at that 3-year period of time horizon, obviously nothing's guaranteed, but I would say, we have a pretty good opportunity of even in a shorter period of time getting back to the highs that we were once at. Just for some commentary, just to go back real quick, I apologize, Jeff. The bull and bear markets on the right, it's kind of tough to take a look at, but bull markets last much longer than bear markets. Bull markets are when the market's rising, bear markets when the market's going down. So, average bear returns, have been about 41%, and their duration's about 20 months. The bull markets returns are about 162%, and the duration's about 51 months. So bear markets are significantly shorter, but unfortunately we are in one currently. Okay? All right. This next slide I really like because I think it's, we talk about, interest rates rising in the Fed. Obviously, people, depending on what channel you're talking to, or maybe all of them at this point, are saying, well, the Fed is behind the curve. They're raising rates into a down market, and it's really impacting people, and we're in a recession. Again, we're not in a recession, but rate increases have historically not meant the end of stock market gains. Okay, on average, markets peak about 4 years following the first rate hike, with a median total return of about 57%. So if you can see here on this chart, it's pretty evident that we have the first rate hike, and you can see the different ones here, and then the date of the next bull market peak, and then the downturn, and then the S&P 500 gain, and how many years it took that bull market ran. So, I'm pretty optimistic to say that whether this is a permanent bear market, or at least somewhat of a more than just a 12-month bear market, and it very well may last into next year, but I would encourage you to keep putting your money in and dollar cost averaging into your 401k, because at some point this market will turn, and it should turn higher. Okay. I really like this next slide, and it talks again. Higher rates don't phase stocks. If you take a look there, these are the periods of time when we raised rates and what the stock market did. Now you'll see, obviously, the 1-year performance of the S&P 500 following the beginning of the rate increases in 1994. The market was barely back to break even, over a period of time, and obviously that's not what we're all looking for, because we want our accounts to rise. But recent history of rate climbing cycles, only that one time where stocks lower 1 year later. Okay? So again, 4 out of the last 5 times the market was positive, and the only negative occurrence was that negative 1% in 1994. And again, this is the number of months or whatever, the number of days, which is 240 days. Okay? All right. The second years of the presidential cycle are usually the toughest, and that's because we have midterm elections. Look, you're about ready to see abundant political ads if you aren't already. So the rhetoric from both sides of the aisle, things need changing. It's going to come over and over again. I don't care which party you're in. just, you're going to see ad after ad after ad, and everybody's going to be blowing up the other side. So as a result, the second year of the 4-year presidential cycle is usually the most volatile leading into the midterm elections. And again, the markets don't like uncertainty. And until they figure out who's going to be controlling the House, the Senate, and so on, the market's going to remain pretty volatile. The average intra-year pullback averages about 6.7%, right, just kind of reflecting that increased level of uncertainty and volatility for the market. In fact, if you think about it, going back to 1970, the second year of the presidential cycle has been by far the least rewarding for any equity investor, averaging about a 5.3% return, which is significantly worse than the other 3 years. I mean, you can see that 5.3, the pre-election year, 18.5, 14.3, and 9.4. I mean, it's nearly half. But the nice part is usually, the third year is the strongest with that 18.5% return. And so hopefully, we're going to look for, we're hoping that this market rebounds a bit. The next slide here, really just kind of to reiterate that volatility piece. If you look at that in that year 2, Q4, year 3, Q1, we're probably in for some volatility into the market. So, the market's going to be rising and going up and down quite a bit. For instance, we look at the market today, and as we're speaking, the market's up about 0.31%. It doesn't mean the market may turn down for the rest of the day. We've been seeing that over and over again. Okay. The next slide, just kind of breaking down the bear markets with recessions and without recessions, shows kind of an interesting development. Should the economy be in a recession, the bear market gets worse, down about 34.8% on average. Again, that's if we go into recession. We might, and lasting nearly about 30 months on average. Only 3 times dating back to 1950 has a bear market occurred without a recession, and each of the 3 cases resulted in relatively short recovery periods, 7, 15, and 19 months, as the chart here shows, okay? And very strong returns coming off those bottoms, with average returns anywhere between 22.8 and 33.2% returns. So not surprisingly, the pandemic-related bear market of March 2020 was the fastest ever, going from a new high to negative 20 in only 16 trading days. I don't see that happening here. I mean, hopefully it's not a continued slow grind lower, but obviously if ultimately we get into a recession, we may see a little bit more pressure, not only on earnings, but the stock markets then will follow. Okay? All right. So if you follow the news on Ukraine, you can join in the guessing game about how many times the Fed will raise rates this cycle, or track the container ships on their appointed rounds. But whatever you do, don't try to time the market. If you want to say, hey, I think he's going to raise rates 3 more times, whatever it may be, to time the market, you have to assume that you're going to get 2 decisions correct. Number 1, when to exit, and number 2, when to return. More likely, you could get both moves wrong, and your portfolio will be worse for wear. Trust me. Investors who missed 2020's 5 best days finished the year with an almost 18% loss. Compare that to the better than 18% return enjoyed by those who stay put. Again, that's in the 2020s. So over the long term, if you had missed just 10 days over the last 20-year period, you'd have reduced your return by more than half. 61,685 versus 28,260. That's a pretty heavy toll to pay, right? So time in the market is much more important than timing the market. A hypothetical investor who missed the 10 best days over the past 20 years nearly slashed their returns in half, 5.3% versus 9.5%. Obviously, this is amplified by the fact that many of the best market days come following the biggest negative days, leading many investors to be stuck on the sidelines. So I want you to think of it in these terms. If you missed the 40 best days of the last 20 years, you would actually have a negative return of 1.51%. But if you were fully invested, you'd average 9.52%. Just let that sink in. So do not try to time the market. I really think it's a tough road to hoe. Okay, this next chart, I just wanted to kind of point out that the market goes up and down, obviously, but clearly this is the average of all the midterm election years from 1931 to present, and then all the other years. Midterm election years are the toughest, and we typically do not start to recover until sometime in October, when it becomes more apparent who's going to control Congress. Okay. Again, as we mentioned a little bit earlier about volatility, here's just some months that volatility typically remains high in those midterm election years. So we can continue to see volatility even through November of this year. All right. I just want to show you just a quick chart. S&P index price return 1 year after a U.S. midterm election looks pretty encouraging to me. I think, and by the way, I'm an investor just like all of you. I have not sold my investments. I've stayed in my investments, and I'm going to stay in. In fact, I'm going to keep putting money in. So, next slide, Jeff. Okay, this next slide, I've been doing this for years and years and years. And what I do is I talk about earnings, and it really is the name of the game. If the earnings move higher, the stock market's going to move higher. And as you can see right now, the last 2 quarters, that we've seen probably pretty much flat earnings year over year, and that's not real thrilling as a stock market investor to see a chart like that. And by the way, 2022 it's kind of the mauve. I don't know if that's a mauve color or kind of a pinkish color, but it's a little disconcerting to see that and say, gosh, where are we going to go from here? And I have a good feeling that we're going to go higher, and earnings will return to companies, and after all, if you follow the earnings and earnings ultimately move higher, the stock market moves higher, and you can see that in the next chart here. These are some estimates of where the market, what the stock market's going to do. Some of those earnings estimates have come down. Have come down, here recently. So, that's usually not a good sign. But we do that often. We are often overly optimistic about earnings in the stock market, in the S&P 500 companies, and then typically they do get reduced over a period of time. But if we take a look out into 2023 and we say, hey, at some point we are going to get back to this higher earnings, I'm pretty confident that market will ultimately move higher from this point, because, again, the market does follow earnings. Okay. So just kind of 9 key opportunities to talk about as we've kind of gone through this is, number 1, make your IRA and retirement plan contributions. You can always consider Roth conversions, obviously, if the market decline has been a factor for you. Consider your cash flow, either slow down or stop distributions until the market rehabilitates. This is where a solid plan B can come in, and like Paul was talking about, kind of going through a plan. I think it's always good to look at a plan. Plans should never start at the date of retirement, but they should actually encompass your many years before retirement and the day you retire and into retirement. If you're thinking of retiring, like I said earlier, perhaps consider delaying that retirement until the market's a little bit stabilized, and consider investing that cash that's sitting on the sidelines. We already kind of said that, look, the market's going to move higher ultimately. If you're sitting on a heck of a bunch of cash, it may be a good opportunity to jump right in. Number 6, consider rebalancing your portfolio, whether that means selling overvalued and less desirable positions or rotating to areas that you were previously hesitant to consider. One thing, when I look at FCN's holdings, I don't have them up currently, but I think about the holdings a lot. We have, for instance, like S&P 500 and different things, of that nature, and a lot of times in the past, those have been great. Those funds have done well, and for years I've always been talking about how value has really underperformed growth, and there's going to be a time that value actually comes back. Well, I think now is that time. It's already come back quite significantly, and probably likely might outperform growth in the near term. Okay, and possibly even for the next 5 to 10 years. The other things is, you can always consider getting more aggressive when the market goes down. If you believe that market's ultimately going to come back, that should, if you have a good long-term time horizon and the proper temperament, obviously, to deal with the market's ups and downs, the market's going to be volatile. It might be for you to move into something a little more aggressive. Number 9, open up a health savings account. We kind of call those a stealth IRA because they can appreciate in value over time. Obviously, in a downturn, it's a good time to put money in. You can always save those healthcare savings receipts, for many, many years and pull that money out, down the road as well. So, again, with that, I do want to mention just a couple things. On number 7, I kind of glanced over that. A lot of people have losses, and this really doesn't pertain to your 401k, but if you do have money outside of your 401k that you've invested in the stock market, and you're, for instance, maybe you're invested in the S&P 500, SPY, there's always a similar investment. So, for instance, if you were to invest in IVV, Indigo Victor Victor, that's the S&P 500 also. It's just a different company. And then that way you could potentially realize that loss, and that's a true savings in an account. And part of that overall return is making sure you're tax efficient and trying to take advantage of any tax implications and offerings that the market may give us. All right. With that being said, that is it. So I'm happy to answer any questions, or if I can, and go from there.
Thanks, Troy. The lines are open, so if you do have any questions, just go ahead and speak up. I'm checking on the chat. It looks like we don't have any questions right now. Paul, Kobe, do you guys have anything that you want to add to what Troy's talked about?
I'm a little older than some of you people, so I know that over time we've had clients that some of them are ready for retirement for the 65 and some of them are not. Many people don't start to think about it until they get to be about 40, but our experience is that unless you start to, with some savings goals, and the 401k is the best first step because there's a round numbers 5% match that you lose if you're not in it. But I know that the people that are able to retire, most of them do it through investment in a retirement plan to begin with. In fact, even if you did the $20,000 a year and then the higher $27,000 a year if you turn 50, it's probably still not enough for retirement. So, but this is a really good step to start. And we have clients that can't retire, and we have clients that retire, and most of the people that can retire, the reason the way they became financially able to do it is they took small steps along the way, as in every pay period, every month, and that's what we would recommend to you regarding your FCN company 401k.
Thanks, Paul. If anybody has any questions, especially if you're watching the replay, again, contact Kobe Clark. His email there is kclark@esullivan.net, and his direct dial number 240-316-3535. I want to thank everybody for being on the webinar today, the FCN 401k enrollment overview. And Troy, appreciate your investment market overview. And again, thanks everybody. If you have questions, feel free to call Sullivan Wealth Management.
Sounds good. Thank you.
All right. Thank you.
Bye.
Thank you.
Bye-bye.